What's up, YouTube? Welcome to the Retire Rich Club channel. My name is Lyndon Jr., and it is my pleasure to discuss with you the latest news in the stock market. Before we continue, I want you to know I am not a financial advisor, and these videos are for educational purposes only. All right. I hope everyone had a good week. I hope your family is doing well. That's what we do in this club. We make sure everybody's good. All right. As for me, I had a great week. I want to take the time out to acknowledge each and every one of you that watched my first video. I really appreciate it. I felt the love. I was overwhelmed by how many people shared it, liked it, and really got something from my first video. So I thank you guys so much from the bottom of my heart for taking the time out, watching the video, giving me your feedback and input. You guys really surprised me, and I really appreciate the love, man. You guys had me walking on cloud nine. I think I got about 100 reviews. The duration time was pretty long. That means you guys watched most of the video, and I'm hoping you guys gained something from it. And I was pumped up all week to give you guys an even better video with better content and even step up my game as a commentator, talking about stocks. So I thank you guys once again for watching the video. But one thing I did not emphasize enough as I learned this YouTube thing, please subscribe. Subscription is a big thing. So please subscribe. Give me a like if you like the video. Feel free to share it with your friends, your family, anybody you know interested in the stocks that may not be in it, or they may be in it already, and tell them I got some good picks for them, some good moves to make. All right, so thank you guys again. And by the time you see this, it should be Father's Day. So I want to shout out all the fathers. Fathers mean a lot. We know we love the moms, but we can't forget the fathers. So I look forward to that as well, my little one, and enjoying the day. So yeah, so that was my week. That was my week. It was great. Like I said, I'm ready, man. So let's talk stocks. All right, so recapping video 1, I talked about where you should be in the stock market, right? We talked about inflation. We talked about buying some of these companies so they could become assets over a period of time, increase your wealth, all right? Yeah, we spoke about if you're not investing, if you don't have your own business, things of that nature, one of the easiest things to do is to invest in stocks and become an owner, a part owner, and get some of the profit from some of your favorite leading companies. All right. I wanted to highlight some returns as I was researching some different things as I put together the show for you guys. I want you guys to listen to the returns of some of these companies in the last 5 years. All right. Let's talk about Microsoft real quick. Their 5-year return is a whopping 417%. All right, that's how much you would have made if you would have invested in Microsoft 5 years ago. So if you put $1,000 down, you would have made $4,000 and a couple dollars after that. Apple, their 5-year return is 447%. 5 years, 447%. This is, you guys could double check this. All right, that was only 5 years ago. So you can imagine if I go back 10 years and 15 years, it just goes higher and higher. Target, all right, they didn't do 400 in 5 years, but they're about 240%. That's their 5-year return, 240%. Visa, they all take on money and interest. They're a company that you could buy as well and invest in. They're at almost 200%. That's their 5-year return. All right. And MasterCard is almost at 300%. These guys take our money when we use that card and we pay that high interest, but you can invest in them and get a return. If you did it 5 years ago with MasterCard, you're up 293%. So this is why I'm so passionate about talking about stocks. This is why I tell everybody about stocks, and this is why only regret I have is that I didn't know about this even earlier. But that's neither here nor there. The time is now. We got the knowledge, and the beautiful thing is we can share it so easily. So I really want you guys to get in the game if you're not in the game. All right. I want to also clear up something that I said last video. I mentioned that I don't like to hold too many tech companies in my portfolio because I said that most of these companies don't make a profit. That was incorrect. There are a lot of companies that are tech that make profits. Um, it's just just as equal the ones that don't, because I explained earlier, a lot of them cost a lot of money to run these companies, and they spend a lot of money to give you guys these services. So their evaluation is very high, but just make sure that if you're investing in a tech company, understand that if they're not making a profit, you can find yourself in a loss. That's what I want to be clear with. All right, there are a lot of great tech companies like Microsoft, Apple that make profit and they give great returns. All right. So I just wanted to clarify that. All right. All right. I also spoke about Adobe. That was something I said that they were having their earnings this week. They did have the earnings and they did great. All right. To keep it simple, they're still growing. They're still making money. They even have a subscription base setup where they're charging you every month for people who use Adobe. It's a creative, um, you see it on your computer right now, probably automatically, and they're doing good. Adobe in the last 3 months, they're up 28%. So in 3 months, you could have made 30% if you invested with Adobe. Last year, they didn't do much last year, but looks like they're breaking out from the price range that they were in the past year. Like I said, in 3 months, they went up 30%. And if you look at the 1 year return, it's a little over 30%. So that means for about 9 months, they were just going up and down. And it looks like they're breaking out from that price range. So they might be reaching greater heights in the months to come. So add Adobe to your watch list if you haven't. They're a good tech company, one of the best ones out there. And I'm waiting for them to drop in price, and I'm gonna buy into them, even if it's just one, or whatever I can put towards it. All right. Right. Now, another hot topic that I want to give you guys. Some of you may know, some of you may not know. All right. There's something called ETFs. That's one of the things I want to get into this video. ETFs. They stand for Exchange Traded Funds. All right. And with an ETF, to keep it simple, it's basically a lot of stocks under one symbol. And within all these different companies that are in this ETF, they have a different percentage that's invested into it. Okay, so like I said, the beautiful thing about ETFs, you're buying one company under one name, but underneath that one name, there's a handful of stocks within it. So think about sports. If you're into sports, if you have a good team of players, then your team should be winning. That's why I look at it. So with ETFs, they're a bunch of stocks, different names. And if you find the right ETF, you should be investing into a winning company. And it saves you from having to buy into every different individual company, which can be a headache at times. You just find a good ETF, put your money into it, and just sit back and make a return. And that's what I did for you guys, because we in this club. I'm here to give you a gift. I got some good ETFs, which is great for people just getting into the market, and you could just jump right in with a nice ETF and learn about different companies, figure out how risky you want to get with your investments. But I got some good ETFs for you guys. All right. So talked about the ETF. Now, one of my favorite ETFs is a stock called XLK. Excuse me. XLK is it's a tech stock, if you want to say. There are 100 companies that are in tech under this symbol. All right, and they have some real good companies underneath this ETF XLK. It's basically well, let me not confuse you guys. So XLK is a tech ETF, 100 companies. Microsoft is about they invest 20% of 20% goes into Microsoft, 20% goes into Apple. So you're at 40% between Microsoft and Apple when you invest into XLK, right? So rather than having to buy Microsoft and Apple back and forth, you can invest into XLK, and every time you do that, you're investing into Microsoft and Apple by just buying them. And that's not the entire list. They have Visa, MasterCard, their role on there. I mean, they have a real good list of companies. You guys could check it out. This is a good time to tell you guys that I use Yahoo Finance. I use Yahoo Finance for a lot of researching stocks from their money that they make every year, the annual returns and quarterly returns. All that's there. Get comfortable with Yahoo Finance, and they're great. It's free. You can get a lot of information from Yahoo Finance. But you guys can check this out yourself. XLK. Look at the list they have. I gave you 40% of what is in that ETF, Apple and Microsoft. And they also have, like I said, MasterCard, Visa. I believe Costco's in there. All right. But it is the easiest money you'll ever make. All right. Now, that doesn't mean if you put your money into XLK, you may see it go up and down. Like I said, that's what stocks do. But in the long haul, you're going to make between 30% to 40% with this stock. I mean, I think I wrote down the percentage that it's at right now. In 5 years, they're up over 200%. So that's a little over 40% for the year. All right. So I want to highlight to you guys XLK. I want this to be the Retire Rich Club ETF Holy Grail. All right. I watch a lot of YouTube channels talking about stocks. I follow people on Instagram, and I've never heard anybody talk about XLK. If you have, please let me know, because I'm walking around here like, why don't they tell nobody about XLK? These guys are supposed to be the best in the game, and I don't hear nobody talking about XLK. Maybe they're buying it, but they don't want to tell you guys about it. But guess what? I just told you about it. XLK. All right. We need that in this club to be the staple of an ETF. Go with XLK. Another one I want to highlight is the name of it is SPY. Guess you could call it SPY. All right. And with SPY, for those that don't know, SPY is how people gauge the stock market, right? When you hear other people talk about their stocks can outdo the SPY or the S&P 500, they're saying that because the S&P 500, like I said, is like the holy grail to the stock market. It's 500 of the best U.S. companies under one ticker, under one stock name. And that is another great ETF that I would tell anybody looking to get into the stock market to buy. Just keep in mind that if you get into SPY, which is, like I said, 500 companies, right? That's a lot of companies. So with SPY, if you look at their returns, it doesn't go up a lot. When I say a lot, I mean you can get 20% on average a year with them. I checked 5 years, and they're almost at about 100% in 5 years. So, I mean, listen, 20% is better than what the bank is going to give you. And it's probably a safe investment for people who, let's say you want to put a lot of money into the stock market and you really don't want to be too risky with some of the other stocks or ETFs. You can invest into SPY, but just understand that you're not on the fastest lane in the highway. You're somewhere in the middle. You might be far right. You're just cruising. You know where you're going. You might even be in cruise control, when you play your Kiss FM or whatever you want. But that's SPY. You're going forward. Don't know how fast, but you're going, and you should not be losing. I mean, it's very rare that you see SPY with a negative return. It has happened if you check it. But for the most part, SPY is about over $400 now. All right, if you check 5 years ago what the price was, I'm pretty sure it was in the upper 300s. I didn't check that yet, but I'm telling you guys, SPY is it is the benchmark of the stock market. Okay, so if you, like I said, want to put a lot of money into the stock market and be with a stock that moves like the stock market, then SPY should be on your list as well. And I have a treat for you guys as we get towards the end of the video with a strategy that I have that I think is great for investing with how you could use these ETFs. Stay tuned. It's coming. And another thing I want to talk about with SPY, and not just SPY, with ETFs, right? Because this is the one of the main topics for this video, ETFs. With ETFs, what's also good about ETFs, right? It's a self-managed stock. So let's say you go with XOK, which I told you I love XOK. XOK, love them. There are 100 companies in XOK. And with all ETFs, if a company is doing bad, they'll take out the company from the ETF and replace it with a better company. I mean, it don't get no better than that. If you look at the S&P 500, which I always look at, like I said, they're the benchmark of the stock market. Every 3 months, they put in new companies and take out companies. And I like to see that, because if I'm investing into a stock, right, that has multiple companies, I know that they're always trying to keep a winning company within their list. You can't ask for more. All right. So even though I said the S&P 500, which is the name SPY, moves fairly slow, I have a gut feeling that's telling me that within the next 5 years, it's gonna move more faster than usual, for the fact that a lot of companies that I'm seeing that's entering this entering the S&P 500, there's some real good companies. I mean, to enter the S&P 500, a company has to make a profit for 3 consecutive quarters, right? So they have a standard to get into the S&P 500. All right, you can't just say my company XYZ, just put them in there. You know, they're good guys. It don't work that way. They want to see have they made profits 3 consecutive quarters. I believe there's a certain minimum that the market cap has to be. So ETFs are good for that reason. Now, don't take all this information that I said about ETFs and think that you can't find ETFs that don't make no money or have lost a lot of money. You still have to have the same caution as you would with stocks, individual stocks. All right. But just understand, with ETFs, you're getting a list of companies that you may like, that you don't want to spread yourself too thin and buy. You just buy one company, that's the ETF. You make sure that they have a good list of companies, and you should win. That's the idea with ETFs. And I'm giving you guys a gift, telling you the ETF that nobody talks about. They've made over 200% in 5 years. The 10-year return is probably over 300%. And nobody talks about it. Why? I don't know. But I just told all you guys, and you could tell your other friends that are in the stock market, that they should put a nice investment into XOK if they haven't. If they're looking for ETF, that's it. All right. So we talked about XOK. We talked about SPY. And I also found another one as I was researching to bring you guys this information. There's another one called XLY. And this is a consumer discretionary ETF. And when I checked what's in their list of companies, they have Amazon, they have Tesla, and that right there, I said, all right, I like this list right here, because I like Amazon, I like Tesla, and this ETF, like I said, is consumer driven, so they tend to have companies that do well in all the consumer driven of avenues, whether it's retail, whether it's food, very heavy consumer investments. The list on this XLY has these kind of companies. So I like XLY as well. Just kind of found out about them, and I'm thinking of putting them on my watch list to maybe start putting some money into them. All right. All right. So I gave you guys a freebie, XOK. All right. Like I said, this year, the stock market, with the inflation talk that we talked about last video, it hasn't been a great year for investing as far as like making some high returns. That's going to change in due time. I really feel like we're ready halfway throughout the year. Excuse me. And it's been a lot going on, pandemic and things of that nature. So just as in anything else, the stock market is kind of filling itself out. It ran up a lot from the lows of 2020, and they did tell us that it probably wouldn't be a big year in returns. Some things got cut in price, but they're back up. So still use this time to invest into companies that are going to do great in 2022. That's my advice to you. When the stock market is kind of stale, it's not going nowhere fast, don't get discouraged. You can either put cash into your account and build your cash in your account, so when the time is right and you hear that it's a bull market, you could jump in. But I would just tell you, me personally, I would just keep on buying the companies that I know are going to do well once the stock market gets going and is on the highway passing the speed limit, because they're just going. You never know when it's going to happen, but it just happens. So when it does happen, you want to make sure that you already have a nice handful of shares into a great ETF or some great individual companies that do well when the stock market is clicking and it's moving. So it's slow now. So this is even, like I said, a better time to buy and buy and buy before the prices go back up again. All right. Now I spoke about investment strategy. Another treat for you guys. All right. So I sat back and I said, okay, as the Retire Rich Club General, I'm leading my club into these high returns, right? How can I get somebody who doesn't really know much about companies? How can I set them up with an alley-oop that can just, get them some good returns, and they could be happy that they're in the club to know about it. So I have a strategy here. Hear me out. If you buy XOK, right, which is the ETF we spoke about, and you buy the SPY, which is another ETF, and if you buy XLY, right, which is 3 ETFs, and you get a fourth company called BlackRock, right, you would have 4 different ETFs, and I believe that's a great balance of stocks that's in the market that you would have. Within those 4 companies, you're covering so much ground in the stock market of good companies that I don't know how you could lose with rotating money into those 4 companies, right? So let's say you're investing $25 every pay period, right? You can pick these 4 ETFs and rotate $25 into each one, right? So you could get one pay period, I'll put $25 into XOK. Next pay period, I'll put $25 into the S&P 500. Following XOY, following BlackRock. And you just keep rotating that all year round. All right, you could do it with 25, you could do it with 50, you could do it with 100, whatever your financial investments are. I'm going to follow this blueprint that I came up for you guys for myself, right? Because I already have BlackRock. And one reason why I like BlackRock is because BlackRock is a big asset management company. All right. So they tend not to have big market swings when bad news comes. We're in a bad period of economic talk. It could be anything, war, president problems, and the stock market reacts to these things, right? The stock market is like a baby that's very dramatic. It hears bad news, things go down for a week or two, sometimes a month, and then they get over it and it goes back to where it was. That's how the stock market is. The stock market, it's very driven on emotion. All right. So so as an investor, you have to understand this, and this is why it's not good to watch your portfolio every day and try to react every day, because the stock market, it's like a drama, and we don't want the drama. We want the returns, right? So we just want to make sure we're buying good companies that over a period of time will go up and down with the stock market, and when it's all said and done, they're gone, right? So that's what we're doing over here. So I gave you guys 4 ETFs that I think. No, I gave you guys 3 ETFs and one company called BlackRock. I think if you find a way to invest into all 4 of those things, in 5 years, your return should be awesome. All right. Like I said, I already buy XOK. I came across XOY thanks to you guys because I'm trying to give you guys the great content and great stock picks. I came across XOY. Didn't know about XOY, but I researched it this week. I like their niche, right? That they're consumer driven into things that do well in the that consumers spend on an everyday basis. Amazon, Tesla, those were some of the high companies I've seen in there. Nike was on there as well, and that's a good list. Look at these ETFs as a basketball team, football team. If you have the best team, they're going to the championship, and that's what these ETFs are gonna do. All right, y'all. So pick one, pick four, take the information, use it however you choose. But I really like the idea of picking the four and doing the XOK, doing the SPY, doing the XLY, and doing the BlackRock. I love it. I mean, I want to toot my own horn, but it's pretty. This is you guys don't understand. You guys are covering so much ground with all the good companies that this is awesome, man. This is awesome. Like I said, out of all four of those ETFs that I gave you guys, XLK will give you the most growth, right? Because those are 100 of the best technology companies. And I told you guys last video, technology companies, the evaluation is very high. So they're the most expensive, right? So you got expensive and you got growth with XOK. XOY is not going to grow as fast as XOK, but you should definitely do more than 20% in a year with XOY, right? SPY would be the slowest growing one. But as I told you guys earlier, I believe the next 5 years, SPY may surprise you and give you that 30% return, or even in a good year, 35% return. Because I really like the new companies that they're putting into this list. They got some real good companies, and they're small companies that are growing. So if you think about putting 500 of the best companies together and they're all growing at the same time, very fast, then you're going to make a greater return than opposed to the companies that might have been dragging them down, right? Because I said earlier, they kick the bad companies out and try to put good companies in. And with BlackRock, like I said, BlackRock is if they're not the biggest, they're one of the biggest asset managers. That means people with big money go to these guys and say, hey, make me more money, and don't come back here telling me you lost it. All right. And that's what BlackRock does. They've been doing it for a long time. All right. They get into real estate. They get into so many different things that are not only within stocks that bring a return. And you need that in a market that can be kind of crazy sometimes, right? So you want to invest in something that is not going to go up and down, or it's not going to go down like the stock market. You want it to go up, but it won't go down like your other stocks because, like I said, they're in a different category. They're asset managers, and they're growing as well. All right. So those are four of what I think is the best ETFs out there for you guys. All right. And for you more risky people, not people, risky investors, let me talk to you guys accordingly. For you more risky investors, there's a ETF called CLOU. You could check out CLOU. Those are some of the newest cloud companies. Shopify is on there. ZS is on there. They have some real new tech companies that may not be making a lot of profit, but as I said earlier, they're expensive. And CLOU is a cloud ETF, right? Some of the best cloud companies that should be big 5 years from now are in there. So if you're a little more risky and you want to take a challenge and go out for that big return, 40, 50, 60%, you might want to experiment with CLOU. I'm not putting that as the retire rich club, what's what I'm looking for, a benchmark over here, but just giving you guys some different choices, right? So CLOU, they're a good ETF if you want to be a little risky and go out there good, get a bigger return, set your stop loss out, and be safe. But I like the list that they have, all right? I like the list that they have, but they're very new and they're not that big yet. So keep that in mind. And I'll give you guys another one because I feel so good. I told you guys I want to go out there and find those needle in the haystack for you guys. There's another ETF called MOAT, right? MOAT. Their moth is how you would pronounce it, I guess. And they tracking the companies that have a edge, right? They have an edge against all the other companies in the service that they provide, right? So just as like I said in sports, if you can find a company that has an edge over a majority of the other companies, then these companies should consistently win. So with MOAT, this ETF focuses on companies that this panel of people that pick these companies believe have an edge over, the other companies in the stock market. Another good one. But I didn't put that on our list of the 4 that I like because I'm still researching it and I'm not too familiar with them. But I like their list, and their 5-year return is over 30%, I believe. Anything I give you guys, for the most part, I try to find stuff that's going to give you at least 20% return in a year, because we're going to talk about compounding another video. But if you can compound 20% every year, we'll talk about the numbers next video. All right, you could be a millionaire in 20 years if you compound something at 20% minimum. We'll talk about that another time. But I really try to find at least 20% with these stocks and ETFs and things of that nature. Now you can also, right? Stay with me, y'all. You can do the 4 picks of the ETF, and to my more experienced investors who feel confident in knowing individual companies that do well, you may want to kick out SPY from that list of 4 that I gave you, and keep XLK, keep XLY, and keep BlackRock. And for the 4th spot, instead of putting in the S&P 500, you can put your favorite individual company, or you could put in 5 individual companies along with those other 3 ETFs, right? Because one thing that I'll share with you guys is, if you don't know, individual companies will make you the biggest return. I told you guys in the beginning of the video, Microsoft was up over 400%, I believe, in 5 years. Apple over 400% in 5 years. Those are individual companies, all right? So individual companies will give you a very big return. But when those companies drop, you're going to lose as much as well if they happen to lose. So individual companies are great, but just keep in mind you're betting a lot opposed to an ETF or something a little more slower in growth. All right. So I just wanted to let you know, for my more experienced people, you can manipulate those 4 picks and throw an individual company in there, a Target, a Tesla. I still think that'll give you a good balanced return. I want to see you guys win. I want to see you guys get the biggest return you can. But I also don't want you guys to come back crying saying I put all my money into Tesla and they went down. I lost all my money. I want you guys to have a balance. I want you guys to take your losses, but I want to give you guys enough wins that you'll still do well, because your majority of money invested went to winners. All right. So that's what I want you guys to do. I want us to win. All right. I want us to get 30% or more every year with our eyes closed. And that's what we're going to do. All right. So we talked about that. All right. I told you guys I got some good content for you guys this video. All right. For the fast moving stocks of the week, I threw on here a company named Nvidia. All right. They're into the chips and gaming chips and things of that nature. I kind of slept on Nvidia, but they're up 36% in the last month. If you own one stock of Nvidia, you'll be up $197 in the past 1 month. They really shot up a lot this past month, 36%. They're a very big company, and they're getting a lot of price targets that these analysts say the company is worth. They're saying, I read this week, that they should be worth $900 because of some new projection in money that they can get if they make a couple of changes. So Nvidia should be on your watch list, all right, and see how far those guys go. So I mean, listen, I gotta cut it here, guys, man. I could talk to you guys all day, but it's the second video, and I don't want to overwhelm you guys. All right. So we talked about ETFs. All right. XOK. All right. I want you guys to know XOK. I want you guys to feel like if you don't know where to put your money, you can put your money into that, and you should do just fine. All right. So XOK is what we talked about. Then we talked about the strategy of maybe doing the four picks. All right. XOK, SPY, XLY, and then I said BlackRock, right? And then for my more seasoned investors, you might want to kick out SPY, right? And put in an individual company of your choice and get a good balance, all right? So I'm gonna wrap up the show. I mean, it went by fast. This was good. This was good. This was good. I want to give you guys the 3 keys of investing in the stock market. All right. Know what to buy, know when to buy, know when to sell. You guys could take those keys anywhere and dominate the stock market. All right. My favorite phrase is investing is not only a choice, but it's a skill. All right. Get yourself in the game. If you're not in the game, if you're already in the game, all right, I hope you're on your A game. And if you are, I'll see you there. All right. Till next time, next week, hopefully. Peace, y'all.